Welcome to Global Capital Engine, where we uncover the hidden mechanics behind the massive shifts shaking the global financial markets today. We are currently witnessing a historic collapse as precious metal prices plummet vertically, leaving investors stunned by the sudden market violence. Gold has unexpectedly broken below the critical 4,600 level, while silver has tumbled down to $72. This is not merely a standard market correction, but what many experts are now calling a deliberate and orchestrated financial crash. Panic is spreading across global exchanges as the sell-off intensifies, wiping out billions of dollars in paper wealth in mere moments. Investors are scrambling to understand why these safe haven assets are collapsing exactly when the world economy seems most fragile today. Liquidity is evaporating from the metals market at an unprecedented rate, leaving a vacuum that drags prices down further every hour. Fear has taken over the psychology of the market, forcing even the most seasoned veterans to liquidate positions to survive the storm. To understand this crash, we must look beyond the charts and investigate the structural mechanisms that triggered this massive downward spiral. The central players in this drama are the major exchanges, specifically the CME and the Shanghai exchange, who control the rules. Evidence suggests that this was not a natural market event but a coordinated attack using specific regulatory tools to suppress prices. The primary weapon used in this assault is the margin hike, a tool designed to increase the cost of holding positions. Over the last 8 weeks, we have seen margin requirements raised 8 separate times, a frequency that is statistically highly improbable. Each signature on these margin hike orders acts as a tightening noose around the necks of traders holding long positions today. These aggressive hikes are designed to flush out retail investors who simply cannot afford the new capital requirements to stay active. When the margin call comes, traders have two choices: deposit more cash immediately or watch their positions be automatically sold off. This triggers a domino effect of forced selling, creating artificial supply that drives prices down further, regardless of actual physical demand. It is a classic manipulation tactic used to clear the board of long positions before the major players make their move. 8 hikes in 8 weeks is an aggressive strategy that signals desperation from the exchanges to control the runaway price of silver. The institutions are hunting for stop losses, triggering automatic sell orders to create liquidity for themselves at much lower price levels. What makes this situation unique is the apparent coordination between the CME in the West and the Shanghai exchange in the East. This global squeeze ensures that there is no safe harbor for leverage anywhere in the world, trapping bulls in a corner. However, this price manipulation has created a massive distortion between the paper market price and the real physical market reality. We must distinguish between the digital price you see on your screen and the actual cost to acquire physical metal. In New York, the paper price sits at $72, while in Shanghai, the physical price commands $100. This premium in the East acts as a giant magnet, sucking physical inventory out of Western vaults and shipping it eastward. The Western exchanges are effectively bleeding their physical reserves to maintain the illusion of a lower price for paper contracts. This spread is the clearest indicator that the paper market is broken and no longer reflects the true fundamentals of supply. Smart investors are noticing this anomaly and realizing that the paper price is merely a tool for speculation, not valuation. The most alarming data comes from the COMEX vaults themselves, which are reporting historically low levels of registered silver inventory today. Over the past few years, the registered silver stocks at COMEX have plummeted by a staggering 74% in total. Trucks are leaving the vaults empty or transporting metal out, but very little new supply is coming in to replace it. The physical buffer that allows the paper market to operate is wearing thin, threatening to expose the lack of real metal. We are approaching a mathematical limit where the exchange simply will not have enough silver to fulfill delivery requests from buyers. The ratio of paper claims to actual available ounces is skyrocketing, creating a game of musical chairs for the remaining metal. When the music stops, There will be far more people holding paper contracts than there is physical metal to satisfy them. This depletion trend has been consistent and relentless, ignoring all price fluctuations and signaling a structural deficit in the global market. Mining production is stagnant and cannot be increased overnight to meet this demand, further tightening the physical supply squeeze scenario. The big players know this inventory data better than anyone, and their actions suggest they are preparing for a supply shock. The current crash is likely a calculated move to shake out weak hands before the inevitable reality of shortages takes over. All eyes are now looking toward the March delivery period, a critical deadline that could expose the hollowness of the market. By crashing the price now, banks hope to encourage contract holders to sell or roll over, avoiding the demand for delivery. This is a classic shakeout pattern, designed to clear the order book of long positions before allowing the price to rise. But like a coiled spring, the more the price is artificially suppressed against fundamentals, the more explosive the eventual rebound becomes. Physical demand remains robust, and low prices are only stimulating more buying from smart money in Asia and astute retail investors. The flow of real wealth from west to east is accelerating, a transfer of power that will redefine the global financial landscape. Ultimately, the laws of supply and demand cannot be suspended forever. Physical reality will always triumph over paper promises in time. We are likely near the end of this manipulation cycle, with the dawn of true price discovery just over the horizon. For those who can withstand the volatility, the current low prices represent a generational buying opportunity before the next major leg up. Owning physical metal is the only way to opt out of this rigged casino and secure true wealth for the future. While the paper markets crash and burn, physical holders sleep soundly, knowing their asset has no counterparty risk or margin calls. The illusion of paper pricing is fading, and soon the market will be forced to acknowledge the true value of scarcity. The market is the ultimate judge, and it will penalize those who sold real assets for paper and reward those who held. Time is running out for the shorts, and the window to acquire physical metal at these suppressed prices is closing fast. Once the physical shortage becomes undeniable, we can expect a price reaction that will shock the world and rewrite history. History favors the patient investor who understands the difference between price and value, and who refuses to be shaken out. We are living through a pivotal chapter in financial history, one where the old rules are breaking and new ones emerging. Gold and silver have survived every empire and every currency collapse for 5,000 years. And they will survive this too. Do not let short-term manipulation distract you from the long-term reality of currency debasement and the preservation of purchasing power. The path to financial security is steep and full of obstacles, but the view from the top is worth the struggle. Build your fortress with real assets, ignore the noise of the paper market, and prepare for the inevitable wealth transfer ahead. Stay vigilant, keep watching the physical inventory levels, and do not be fooled by the price games played by exchanges. Knowledge is your lighthouse in this storm. Understanding the mechanics of the crash empowers you to act without fear or hesitation. In a world of digital illusions, tangible assets remain the only anchor of truth that cannot be printed or deleted. Open your eyes to the reality of the situation. The price is fake, but the shortage of metal is very real. Market justice may be delayed by manipulation, but it cannot be denied forever. The equilibrium will be restored with force. From the ashes of this crash, a stronger, more honest market will eventually emerge, driven by true physical supply and demand. Protect your portfolio with the shield of physical allocation, and let the manipulators play their games with paper contracts alone. The storm will pass, and when it does, those who held onto their real assets will be the ones standing tall. Maintain a long-term perspective, zoom out from the daily charts, and see the bigger picture of global monetary instability. Hold fast to your convictions and your physical metal, for the greatest transfer of wealth in history is currently underway. Paper currency always returns to its intrinsic value of zero, while gold and silver retain their value across all generations. You cannot fight the tide of economics forever. Eventually, the dam will break and the true price will flood the market. Plant your seeds now while prices are low, and have the patience to wait for the inevitable harvest that is coming. Precious metals are the key to unlocking financial freedom and independence from a system that is designed to devalue your labor. We hope this analysis has helped you piece together the puzzle of the current market crash and see the truth. If you found value in this report, please support us by sharing this video so others can understand the manipulation. Leave a like and tell us in the comments, do you think the price suppression will end before the March delivery? Join our growing community of informed investors who are taking control of their financial destiny in these uncertain and volatile times. Thank you for watching Global Capital Engine. Remember to subscribe for more deep dives into the truth behind financial markets.